Hey, good morning, everyone. I'm Mike Mbayi. I'm a legal director at Pinsent. I'm also co-chair of the CMU committee of the LPEA. For international audience, LPEA, the Luxembourg Private Equity and Venture Capital Association, is the most trusted and most relevant body of private equity actors in Luxembourg, with a presence in Luxembourg. And for this videocast, I have the pleasure to welcome you, and we'll talk about fund finance. And you have the great pleasure to receive today Nick Mitra. Hello, Nick.
Hello, Michael. How are you?
I'm great, Nick. Thank you. So Nick is the a board member as first vice chair at the Fund Finance Association, and as well a managing director at Societe Generale in New York. So he's one of the most respected and most known banker in terms of fund finance. We have really the honor and the opportunity to receive him and to discuss about this topic. So Nick, how would you define fund finance? What is fund finance?
Sure. Firstly, Michael, thank you for hosting the webinar and thank you for your kind words. So fund finance at the very basic level, and we'll dive into it a little bit. It's just providing financing to funds which can be private equity, private funds, or public funds. Um, So what people talk about today when they refer to fund finance, you can have financing for hedge funds, for UCITS, for mutual funds, redemption lines, and then that's a little bit more on the what we call the open-ended type of funds. And now you have the closed-ended funds, which is what a lot of reference in today's world seems to be for fund finance. So that is typically funds that have a drawdown structure and and can invest in it started off in real estate but can invest in many different asset classes, everything from real estate, infrastructure, private equity, private debt, secondaries. There's a whole gamut. Any venture capital as well. Any private fund set up with a drawdown structure, tends to fall into what we call today as fund finance. But again, just to be clear, most of my comments will be on the private side, not on the public side, which, as I mentioned, can be hedge funds and others. But there's a whole other market for that. But when we this conversation will be around the private side of it.
Thank you very much, Nick, for this clear explanation. And why actually a fund sponsor would come to a bank to have a solution? So what are the benefits of fund finance?
Sure. So there are two major benefits, and we can dive into a little bit as to how the different products are evolving in the marketplace and how they fit into these benefits. So one is, which is traditionally how fund finance started on the private side, which was a liquidity management tool. It was a way for the fund to manage an investment coming in. They're putting money down for an investment in the hope of winning the bid. And if they do win the bid, they have to put a down payment. Excuse me, it's a lot easier to make one borrowing from the bank and then put that down payment if you win the bid, and then call capital from your investors over time. If you didn't win the bid, you would have called capital from investors, you would lost the bid, now you return the money. Investors are not always set up to manage day-to-day cash movements such as that. They expect when there's an investment, there's a drawdown, it remains drawn down for a while, not the back and forth. It helps with timing. So if you have a fund with 300 investors, if the date you need the money, you don't have to wait for the capital call to come in, and then there could be some laggards for various reasons or so. So you will have certainty of your cash being available when you need it to make your investment. A lot of funds have also used it for FX and cash management needs, whether there's a margin call on an FX or such. And in a lot of cases, FX can be incorporated directly into the fund finance lines. Another step, easing the operational burden of the fund. It makes the reporting a lot easier. Also, when the fund is ramping up while you're still raising capital, and the intention being that you want all your investors drawn pro rata. What that practically means is with every investor close, you're sending money back to the prior set of investors once you've made investments, which again, operationally, that's very difficult. You're managing and it's much, much simpler to just keep investments that you make in the initial period of the fund before the fundraising closes. run them on the line, and then make a capital call, clean up the line, and as investments come, if further investments come in, you can draw the line as you see fit. There's been a lot of conversations between the LPs and the general partners on the use of the lines. LPEA, the Institutional Limited Partnership Association, has also come up with guidelines, the majority of which revolve around disclosure of these lines. So limited partners are aware that a commitment has been pledged, and a lot of general partners, fund managers work out with their LPs the time frame on which they're going to call capital. Some will call capital on a quarterly basis, some on once or twice a year, some once a year. But that's a little bit of the landscape of, as so there's the liquidity management, and of course, as the name implies, the financing side of it. There's also a leverage side to it. The traditional product, which was subscription lines, is actually very limited in terms of the actual leverage it adds to the fund, because it's by definition a subset or a percentage of the capital commitments. So as the capital commitments get drawn, as equity is injected into the fund, the remaining unfunded amount goes down. The unfunded amount goes down, you're always going to be below that number in the traditional subscription line. Now, there's a new emerging set of products, what we call the 2.0 fund finance, where you can actually look at that as being, they still have the liquidity benefits, but also they tend to be more on the leverage side, what we call the NAV lines, pref equity, hybrid lines, topco, GP financing. All of these are different versions of leverage, but at the fund level, secured with their own collateral, different from, say, a subscription line where you look up to the investors for your collateral. A NAV line looks down at the investments for collateral, and a hybrid line would combine the two and see and figure out, and come up with a borrowing base that takes both up at the investor commitments and the investments into account.
Yeah, thank you very much, Nick. Indeed, so yes, your explanation is clear, and it's clear that the fund finance tool is essential for fund manager to be able to differentiate himself from the competition and from the other, to have really the good understanding of the tool, and to be assisted by a good bank and good lawyer who really understand the market. And regarding the evolution of the market, so as we've seen, you are one of the most experienced bankers in fund finance, also a founding member of the Fund Finance Association. So how have you seen the fund finance market evolve during the last 15 years?
Sure. So fund finance actually started a little bit before the 15 years. It started about 30 years ago in the real estate space, where people were trying to figure out a way to monetize these capital commitments that were not showing up on any fund's balance sheet. So the lawyers came up with a process, and a structure to do so. And the good news is that structure has held for over 30 years. The basic structure of the pledge of the capital commitments with the pledge of the accounts, with the counterclaim set of defense, a requirement that LPs agree to fund for purposes of repaying the line. That structure has remained. And so to answer your question, in the last 15 years, it started off previously as real estate. The last 15 years, the capital call product, which we estimate the market size overall to be about $800 to $1 trillion in aggregate outstandings today, evolved beyond real estate. It went to, as the asset class that meant for private equity, private debt, infra, secondaries, venture capital. Private equity is probably the biggest portion of that, but that reflects the underlying private capital markets, where private equity tends to be the largest share of those types of those funds. Over time, what was strictly an institutional collateral product evolved into what we call designated investors. So they're investors where you have more limited information, but you're still able to underwrite them. And then since, I would say, the last 5 years, there's been an explosion, particularly during COVID, of what we call fund finance 2.0. The things that I touched upon before: NAV lines, pref equity, hybrid lines, topco financing, GP financing, management company financing. These are different versions of what has happened as banks have gotten more comfortable lending to private equity funds and seeing the performance of the product over the last 15 to 30 years and how well private equity funds have performed, in addition to a need from the underlying funds to look for new sources of liquidity or new sources of leverage while still making sure that the bank and the investor groups are comfortable. The other big evolution in the space has been the entrance of new capital. Typically, this has been an insurance, a bank product for the last 30 plus years. But increasingly, in the last 3 to 5 years, insurance companies, asset managers have come into this space with different product types. Whether in certain cases it's a direct participation in a loan, in other cases, it's a first loss piece where you tranche out the structure. Other cases, it's a funded insurance piece. In other cases, it's an unfunded insurance or also a participation. So the many different formats that we're seeing alternative providers of capital come into the space, providing different, meeting different needs for different banks. A lot of banks have been having limit issues only because the product has grown, from what was 400, 500 million right around the great financial crisis to now almost a trillion. Banks are having some version of a capacity issue. So banks have addressed it in different ways. Everything, as I mentioned, from participations to limit relief trades to balance sheet optimization to first loss pieces where you get capital relief. So it has evolved. Having said that, even as this evolved, the flagship product still remains the subscription line. And just to put things sort of in perspective as to size of these different markets, subscription lines 800 to a billion to a trillion USD in aggregate outstandings. The estimate has been, it's difficult to get a proper estimate on the 2.0, but if you had to estimate, we think it's somewhere between 15 and 20% of that size. Everything, because it takes into account P secondaries, it takes into account true NAV lines. You get some cases people will even include in middle market loans and such because they are effective. Another form of like private debt financing is also can be also included in here. So that's a broad landscape. It's an extremely exciting time to be in fund finance because of everything that's evolving. The older subscription product continues to perform, and because it continues to perform, all of these new products have just exploded. The interest in these products has just completely exploded in the last, as I said, 2 to 3 years.
And Nick, how do you see the role of Luxembourg in fund finance?
Sure, it's very, very important, and the reasons for this is everything from, and we see a lot of funds being formed in Luxembourg, and from a lender's perspective, we have a lot of comfort in the Luxembourg structures. Everything from political stability to a business-friendly climate to the right tax regime. All of those, and also being in compliance with the EU directive, all of the different things that we look for as a bank. What do we care? We care about getting our money back, and to make sure that if there is a bad situation, we're able to enforce. So the first part, our lawyers, the street, are very comfortable with Luxembourg structures. So that means that you're not dealing. You have a fairly good idea as to what are the conventions under the law, what the underlying statutory rules are, and the enforcement and such. So you have a very good base for that. And then secondly, when it comes to enforcement, we've not. The good thing is this market has not had a lot of cases where enforcement has gone to it, but in all our conversations with lawyers, with firms such as yours, it's considered one of the better jurisdictions to do business in, especially for fund finance, and especially because the comfort that the bank market, speaking for myself, the bank market and the borrowers have with Luxembourg law.
Yeah, indeed, as Luxembourg lawyer, I can only concur with what you say, because indeed, one point is legal certainty that you have because you have a first-class financial collateral regime, which gives certainty to banks and comfort. But you have also a great regime in terms of fund formation, variety of funds and so on. So if you combine both, I would say it's ideal place to practice fund finance in Luxembourg.
Absolutely. And look, we've seen other jurisdictions, but we certainly see a huge growth in Luxembourg, especially in the last year and a half, for sure.
And Nick, as I say, you're a founding member of the FFA, so the Fund Finance Association. Can you maybe give us a word about the association and what is the role of the association and so on?
Sure, sure. So the Fund FFA, Fund Finance Association, started off, as really at one of the law firms' conference rooms as a lunch meeting of around 50 folks. Those 50, now that has grown from 50 to 200 to we would hold an annual conference. It was in New York. We ran out of space in New York. We ended up going to Miami. We launched a London conference as well as an Asia conference as well, where we've gone with Singapore and Hong Kong. At the very basic, it's an organization for networking, for education, for mentorship, to advance, to address if there's any regulatory issues or questions that come up or proposed rules that come up, whether from the SEC or from the European regulatory regimes, to address those and have an industry response. So we grew from, as I mentioned, from 50 to what is today. We estimate the fund finance market based on different estimates, directly or indirectly. There are now 9,000 folks who are now directly or indirectly involved with fund finance. Our conferences, which are the main, the only sort of non-partisan, I should say, conference that's held in fund finance. This year, we're expecting almost 1,400 folks to come to Miami, which will be the largest ever compared to 900 last year. Europe has been a huge success as well. In London, our annual conference this year, again, we're expecting 600 to 700 at least or so, and then similarly in Hong Kong as well. So as the markets evolve, the FFA has evolved with that. As an education, networking, conferences, and responding to LPEA, responding to LSTA, those are all functions that the FFA takes on as needed. There are a few initiatives that the FFA does run. So of the 9,000, I mean, the whole organization is run by 9 volunteers, as well as Sequence and Michelle Bolenbrook and Katie Holmes, who help us, as well as Dee Sklar, who help us manage all of these activities. But it really is a testament to the volunteers within the community who step up for the executive committees, the advisory committees, the content committees, and help pull this together. Otherwise, 9 people really can't do that much in as big an organization. Related to that, we have initiatives such as the Next Gen initiative, which is for the rising stars of the industry, diversity, mentoring, FFA University. We have awards as well. So a number of very exciting initiatives that are going on within fund finance, all of which, by the way, are very. I should say that the culture of our industry is one of more, say, we definitely compete with each other, but certainly one of cooperation as well, where folks will, it's not as adversarial. It's very, very competitive for sure. But on a personal level, it's not as adversarial as some of the other parts of finance.
I see. And what's on the pipeline of the FFA?
Sure. So as one of the big initiatives we're launching is FFA Cares. A lot of folks have said we want to give back to the community. And so they've been run so far, but we're launching it more formally. More specifically, within this year, we have the flagship conferences. So Miami is in early February, which is the global conference. In Europe, we have June 5th to the 7th. We have what we call the Executive Summit, which is in the Belfry, just a little north of London. Hong Kong, we're back to Hong Kong in October. That's for the APAC conference. In addition, there are FFA University events that will happen twice a year, both in Europe and the US. We might launch an Asia version as well. We're also going to have global update webinars. A lot of folks have told us, especially going into their year-end planning, it's helpful for them to see what is the perspective beyond their bank or their the fund manager's position. What are other folks in the market saying as they plan for next year, whether it's capacity or internal conversations? It's helpful for them to have that color. So we will do that twice a year, and also in the pipeline are the awards, which is, as you're aware, we have annual awards that go through everything from lifetime achievement to Women in Fund Finance awards to the next gen and to diversity and such as well. So that's what we're looking forward to. It's looking like a very busy and active year, a very good one.
Definitely. And if there are investment manager want to be involved or fund sponsor, who they can contact or to be
Sure.
involved in the
Sure.
association?
Our website, fundfinanceassociation.com, lists all of the board members. And please feel free to reach out to the board members. We absolutely welcome different volunteers for the organization. It only makes the overall organization stronger and is mutually beneficial. A lot of GPs, where initially we didn't always have the GP participation, this year it feels like the tables have switched, where we have more GPs who are seeing the value of fund finance, seeing the impact on their funds and the management and the liquidity management. And so there's been a lot more volunteers over there, and access, coming into our conference also gives you access to like a GP only breakfast and other private networking events among fund managers. So not only do a lot of our borrowers come in and mingle with other general partners, but they also are able to see all of their bank group, for example, the bank syndicate in one shot in a very efficient way. So if there are folks who are interested in the FFA, please raise your hand. Michael, I would ask if the inquiries come to you, please pass them on through to us, or also please feel free to reach out directly through the fundfinanceassociation.com website.
Thank you very much, Nick. Thank you for your time today. It was a great conversation. A lot of very helpful information. And it was another pleasure to have with us today at the LPEA. Thank you, Nick.
Thank you, Michael. Thanks for having me.